Last week was pretty decent for equity investors. The hope is that the worst is over for high interest rates in the States and that cuts are coming before too long. We are, of course, getting that Jackson Hole meeting of central bankers. There may be more clues from the Fed. Our guest says while analysts are awaiting a soft landing for the U.S. economy, he thinks a recession could unexpectedly hit our neighbor this year. We are joined by Peter Berezin, chief strategist at BCA Research. Peter, thanks very much for coming on the show.
It's my pleasure.
What could cause the U.S. to slide into a recession, do you think?
Well, I think the U.S. is already on a path to recession. A lot of the insulation that protected the economy back in 2022 and 2023 has disappeared. Back then, there were so many job openings that people who lost their jobs could walk across the street and find new work. They can't do that anymore. There aren't enough job openings. Back then, there were over $1 trillion in excess pandemic savings. That money has been depleted. Of course, back then, people were also insulated because they were able to refinance their mortgages during the pandemic at very low rates. But increasingly now, more and more homeowners are saddled with these higher rate mortgages, and so they're struggling. So I do think that we're slowly sliding into a recession. The analogy I like to use is just of cooling water. Put a hot glass of water into the freezer. It's not going to turn to ice immediately. You have to wait a bit. Unfortunately, that time has come.
And so did the U.S. economy get overheated? I mean, to use the kind of traditional economic cycle. Did it get overheated so the Fed had to raise interest rates and now they've overdone it and are pushing the economy into a downturn?
Absolutely. And that's what helped to cause this bout of recession, bout of inflation that the U.S. and many other countries experienced. But at this point, the impact of higher rates has done its work, and the Fed is now behind the curve. And people talk about how rate cuts will be great news for the stock market. But look at the last two recessions outside of the pandemic. They all began just months after the Fed started cutting rates. This time is not going to be any different.
You are pretty pessimistic on the S&P 500. You say we could see it go down as low as 3,750 next year, and that would be a drop of more than 30% from current levels. Is that your base case?
That is my base case, and I actually see that as a somewhat optimistic assumption because it assumes only two things. One, that the P multiple on the S&P drops to 16, and two, that earnings estimates fall by 10%. If you look at the last few recessions, the P multiple has typically fallen well below 16, and earnings estimates have typically been cut by closer to 20%. So in fact, 3,750, as bleak as that sounds, might be somewhat on the optimistic side.
That's but so earnings will collapse or near collapse according to your analysis.
Well, a 10% decline in earnings is not that significant by historic standards. And this time around, it actually could be worse because profit margins are so incredibly high. If you believe that profit margins tend to mean revert, then earnings could decline a lot more than 10%.
Markets do well in an election year, traditionally, or presidential election year. Will that keep stocks aloft for now?
No, I don't think so, because many of the possible configurations for Congress and the White House next year are quite unfavorable for equity. So, for example, if the Democrats manage to sweep, win the White House and gain control of the House, they're going to increase corporate taxes. That's going to be bad for stocks. If Trump wins, but the Democrats retain control of the Senate, he's not going to be able to pass any tax cuts. Rather, what will happen is that he will raise tariffs considerably, and that's going to depress the stock market. That's going to depress the economy. So many of the possible configurations after November are actually quite unfavorable for equity investors.
That's interesting because last time Mr. Trump was in the White House, he hiked tariffs and quite a few American industry groups said, please don't do this, but he went ahead.
Well, that's right. In fact, if you look at manufacturing employment in the U.S., it didn't increase at all after the tariff hikes, nor would I say did corporate investment increase after the tax cuts. So many parts of Trump's agenda would not necessarily be that good for equities.
Although I suppose you could say that, I mean, I think admirers of Mr. Trump would say, well, China has abused its trading relationship for years, and finally somebody stood up to them.
Well, I think that's a fair point. And if the issue here is around geopolitics, then I can see the case for increasing tariffs. But strictly from the perspective of what is good for the economy, it's not at all clear that higher tariffs are a good solution. Higher tariffs are a tax on households. And in fact, the Peterson Institute did a nice simulation looking at what would happen if Trump raises tariffs in the way that he has pledged and the income tax cuts are extended. And what they found was that for 80% of households, the bottom 80% of households, I should add, the impact on disposable income would be negative because the impact of the tariffs would more than offset the benefits from lower tax rates.
Where would you tend to put money then right now? I'm guessing that you'd suggest owning a substantial weighting of bonds.
That's right. We expect the 10-year Treasury yield to fall to 3% next year. So that implies quite a bit of upside for bond prices. I mentioned that stock prices are going to go down. So clearly investors should be overweight bonds, underweight stocks. Within equities, I would recommend favoring defensive sectors such as utilities, consumer staples, and healthcare. And also, look a little bit outside of the equity realm. We've been advocating buying the Japanese yen as a hedge against a global recession. It's been working pretty well over the last few weeks. And those who are even more conservative could consider buying puts on the S&P. Volatility spiked a couple of weeks ago, but has come back down. Those puts have cheapened quite a bit.